Jim, great having you today on my show. How are you?
I'm fine, Mark. Thank you. Great to be with you.
Yeah, you're a big insider. You're a true legend. You worked for decades on Wall Street. And now, right now, you published a new book, The New Great Depression. Yeah, it's an incredible book, actually. So do you expect a depression? Tell us something about it.
Yeah, I actually think we're in one. I have an advanced copy of the book. It's The New Great Depression, Winners and Losers in a Post-Pandemic World. Yes, in my view, we're in a depression. By the way, Mark, just as a quick aside, my books are translated into a lot of languages, and I have a very good publisher of a German language edition of my book. It's if not, my German's not very good, but a Finanzbuch Verlag, FBV.
You know what? You know what's funny? This is my publisher as well, the Finanzbuch Verlag. Yeah, Christian Jund. I say hello.
Well, it's very good. But the funny thing is, usually when you publish, in my case in English, it can take 6 months or longer for, let's say, a German language edition because they have to do the translation, etc. But FBV was so enthusiastic, they got an early copy. The German edition came out yesterday.
I know.
So
I know.
They actually beat the English version. So
they're fast. They're fast, and I will put the link in the show notes, of course. And my next book, it's called the Biggest Chance Ever, will be published there as well, end of March. And
wow.
And I just like the guys; they're really cool. And it's a great book you wrote. I had the chance to read it before. So you expect depression? Just tell us something about it.
Sure. I would say, first of all, I would say we're in a depression right now. It will last for a long period of time. But a lot of people get confused, and one can understand why, about the difference between a recession and a depression.
Yeah.
Most mainstream economists, they don't like what I call the D word. They don't talk about depressions. They talk about recession. So a recession is conventionally defined as 2 or more consecutive quarters of declining GDP.
Yeah.
There are a couple other features, but that's basically it. So if you have 2 or more down quarters in GDP, that's a recession. And economists like that because it's quantitative, it's well defined. We have a group in the United States called the National Bureau of Economic Research.
Yeah.
It's a private group, but prominent economists. They're based in Cambridge, Massachusetts. So a lot of Harvard and MIT professors, but a lot of former government officials are involved as well. And they're like, and I know. I probably shouldn't use baseball metaphors for a German audience, but they call the balls and strikes or the penalties or foul, but they decide when recessions begin and when they end. And they've already said a recession began in February 2020. And I agree with that. I reached the same conclusion, but that's their official call. They have not said it's over, but that's not unusual. Often they'll wait, sometimes a year, get more data, and then look back and say, it was over in 2020, but they might not say that until this summer. But it's highly likely that they'll say that the recession was over in July 2020. And the reason for that is, in the United States, first quarter down 5%, second quarter down 31% annualized. Third quarter, it went back up 33%. And then fourth quarter, we don't know. Estimates are maybe up 8% or so. So if you look at that, you say, okay, you had your recession in the first and second quarters of 2020, but it was over by the third quarter of 2020. And that is probably right. Although I would say for the viewers, we're probably in a new recession right now, technical recession right now in the first quarter of 2021. We just got employment figures released today. They're showing more job losses. We were getting job gains. Now we've had job losses again. We'll see. But it looks like and this would be the first back-to-back recession since 1980, 1981. So you have a recession, you come out of it, and then you go right back down into recession. So that's technical recessions. Depressions are different. And a lot of people think, well, if a recession is 2 quarters of declining GDP and a depression is worse, well, depression must mean 10 quarters of declining GDP, as if it's a really long recession. And that's not the definition. The depression means depressed growth. Growth is depressed relative to trend, relative to potential. So you can actually have growth in a depression, but the point is the growth is too weak. And so this is what we're in. We had Yeah, the third quarter, when you went down that sharply, you were going to come back pretty steeply. That's natural. But we didn't come all the way back. People say, well, okay, you went down 31% and you went back up 33%. So aren't you back where you started? And of course, the answer is no, because you're applying the 33% to a smaller base. So if you normalize, let's say 2019 is 100% of 2019 output. You go down 5%, and then you go down 31%. Well, now you're around 65% of the prior output. Well, if 65 is the new base and you go up 33, that adds 21 or 22, but you're only back to 87 because you're working off a smaller base. Even if you have, in my example, 10% growth in the fourth quarter of 2020, it's 10% of 87, so add on 8 more. You're only back to 95. So a simple way to understand it, you fall into a 50-foot hole, you climb out 20 feet. Well, that's good climbing, but you're still in the hole. You're not back to where you started. And this is the nature of a depression. So we had growth in the third quarter and fourth quarter of 2020. I think growth will decline in the first quarter of 2021. But a better comparison is maybe Japan. I would say Japan has been in depression since 1990.
Yeah.
Now, it doesn't mean now they had growth and recessions and growth and recessions. You can have 2 or more recessions in a depression with periodic growth. But the point is you never get back to the old potential. I mean, good example, the Japanese stock index, the Nikkei index, in New Year's Eve 1989, it was 40,000. Today, 30 years later, it's about 28,000, but okay, it came off the bottom, but it never made it back to the prior high.
It'll never be.
Oh, I think that's right. It may never be. And another example, in October 1929, the United States stock market crashed, a very famous crash, but it lasted for 3 years, and when it bottomed in 1932, it was down 89.2%, almost 90%. That's what a stock market crash looks like. But then you ask people the next question and say, well, when did it get back to the 1929 high? How long did that take? The answer is 1954. Yeah. It took 25 years to get back to where. Now, it doesn't mean you couldn't make money in the meantime. You could have bought the low in 1932 and made money in 1933. But that's what depressions look like. That's the kind of thing we're in. This will be intergenerational. The effects of this will last for not 30 months, but 30 years. Wow. And there's very good evidence to back that up.
Okay, so Jim, when I read your book cover, it sounds like a horror movie, actually. Let me briefly read it to the viewers what it says. So the current crisis is not like 2008 or even 1922. The new depression that has emerged from the COVID pandemic is the worst crisis in US history. Most fired employees will remain redundant. Bankruptcies will be common, and banks will buckle under the weight of bad debts. Deflation, debt, and demography will wreck any chance of recovery, and social disorder will follow closely on the heels of market chaos. The happy talk from Wall Street and the White House is an illusion. The worst is yet to come. So what do you mean with the worst is yet to come? What changes do you expect, or even which events do you expect for the society?
Well, thank you. And that's a good kind of capsule of the thesis of the book. Although I will say I had this debate with my publisher, my editor in the United States, and a very good relationship. Very happy with them, but you go back and forth. You're an author, so there's a little bit of give and take. So my top editor said to me, this is last spring when we were planning the book. She said, Jim, so you're writing about pandemic and depression. You have to have a happy ending. You have to leave the reader with something positive or affirmative. But I said, well, that's right. But what she meant by that was, okay, we're going to be very candid and realistic, describing what the problems are and how they will persist. But we have specific recommendations, portfolio allocations, asset classes you can look at. So my point is, it will be bad, and I'll explain why, but you're not helpless. There are things you can do. I point out, here's an example that might be particularly resonant with the German-speaking audience. We all know about the infamous Weimar Republic, hyperinflation of the early 1920s. Everyone knows this story. But in the middle of that, there was a German industrialist. His name was Hugo Stinnes. And he went out, he saw it coming. He borrowed heavily in Reichsmarks, which were the currency of the time. He invested in hard assets. He bought steel, coal, transportation, shipping, railroads. Then the hyperinflation came. He paid back his debts. I would say, pennies on the dollar, but it was a thousandth of a penny. The Reichsmark was basically worthless. So he repaid his debts for practically nothing, but he kept the assets. And he became the richest man in Germany.
Yeah.
And his nickname, I don't speak German, but I was Inflationskönig, the inflation king, as we would say in English. Mm-hmm. So the point is, even in the worst hyperinflation of any industrial economy in history, here's a guy who becomes the richest man in Germany and today's equivalent of a multi-billionaire, maybe like an Elon Musk, because he saw it coming, he anticipated it, and he made the right moves. Yeah. In the United States, we have Joseph P. Kennedy, the father of President Kennedy. So in the 1920s, he had a gang, and they would ramp the stocks, bid them up, sell them to kind of unsuspecting investors, and then walk away with the money. But in 1929, he also saw a crash coming. He shorted the market and made another fortune. In the early 30s, he was one of the richest men in America. So my point is, even in hyperinflation and stock market crashes, if you understand them and you see them coming, there are things you can do to, at a minimum, preserve wealth and even prosper, even make enormous gains. So that's what we do at the end of the book. But Mark, to your question, why is this going to persist? There was a study, and I talk about this in my book. And by the way, there are 200 technical endnotes in the book. People don't have to read them, but they're there. And my point is, it's almost worth buying. I hope everyone enjoys the book, but it's almost worth buying the book just for the endnotes, because you can look at these original sources. But there was a group. It was an economist at the Federal Reserve Bank of San Francisco and two academic economists, I believe from the University of California, but some prominent school, and they looked at all of the pandemics in the last 650 years, going back to the Black Death. I often criticize economists because their time series are too short. They say they're doing correlations and regressions. I was like, well, no, we need a much bigger time series. Well, 650 years is good enough. But they went back to the 1350s, to the Black Death, and they looked at every pandemic in which 100,000 or more people died. The fatalities were 100,000 or more. Of course, the two worst were the Black Death, the plague in the 1350s, and the Spanish flu around 1918, 1919. The Black Death was about 75 million dead, they estimate, and the Spanish flu was 100 million dead. And then after that, there were several where there were 2 million fatalities and some fewer. They were using 100,000. Well, there were only 15 pandemics in the 650 years where 100,000 or more died. COVID-19, by the way, is going to end up being third on the list. Right now, it's fifth, but we have over 1.8 million fatalities, but it's not under control. So you can see that number is going to go past 2 million. It'll pass the Asian flu, and there was one other influenza in the late 19th century. So it's going to be third on the list. But what they asked themselves, because they're economists, not doctors, and they said, well, how long did it take these economies to normalize following these extreme pandemics? And the answer is, on average, 35 years, not 35 months. And just to kind of give a concrete example of that. So I grew up in the 1950s, 1960s. It was a very prosperous time in the United States. I did not live through the Great Depression, but my parents did, and my grandparents did. So I was raised with a sort of depression mentality, even though I didn't live through it. And when we were little kids, 9 years old, my parents would send us that. We'd take our wagons and go door to door and collect tin cans and newspapers. And we weren't doing it for environmental reasons. It might have been good for the environment, but we were doing it for recycling, because all that stuff could be turned into buildings and so forth. And so, as I say, and that didn't change until the late 1960s, when the baby boom came of age, and then we just started partying and using credit cards and everything else. So it did change, but it took 30 years to change. In other words, the behavioral and adaptive effects of the Depression of the 1930s lingered through the 1960s. And that's my experience, but it's consistent with what these researchers found out. So that's why I say, as this, when Jay Powell, our chairman of our Federal Reserve, says, well, we think interest rates are going to be zero until 2023, I say, that's right, Jay. By the way, try 2043, because that's a better way to understand what's going on.
Yeah, but you can't tell the people the truth, they would totally flip out, and yeah, we had riots on the streets, I guess. But I think you're right. There is always a chance in a crisis, you know. And right now we see the biggest wealth transfer in human history, and that's why I call my next book The Biggest Chance Ever. Because if you right now take the right decisions, make the right decisions to invest your money wisely, actually you will be the winner of this crisis. Perhaps you are the inflation king again in Germany or in the States or somewhere. So what do you recommend for the people, for the audience, for your readers of this fine book to do with their money, with their fiat currencies?
But that's a great question, and this is in chapter 6 and the conclusion of the book. After we go through the pandemic, the lockdown, the depression, I talk about why monetary policy will not work. They'll do it, but it won't work. Why fiscal policy will not work. They'll do it. They will print money and they will have deficit spending, but don't call it stimulus because it's not going to stimulate anything. And I explain why. But at the end, when we get to asset allocations, I said the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So when stocks are hard, they'll go up together. I'm not saying they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks. That's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says, sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bonds, 10-year bonds. And the reason for that is, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math, but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried out feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation. And eventually we may, down the road we may, but not now. Deflation is a greater danger. So if inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders.
Yeah. Yeah. And all this cheap money will definitely go into stock markets, in real estate, in other asset classes like, I don't know, Bitcoin, gold, silver. And the central banks are actually in a vicious cycle. They can never get out, actually, because if they raise the interest rates, then I think the economies will collapse. We will see a
Correct.
slowing economy and all the debts. We have
But
debts like never before. But I have the feeling that the medicine isn't really working in the last couple of decades. It's getting less and less effective. Or what's your point on this?
well, I agree with that completely. And this to take it a step further, we can explain why. So let's just talk about monetary policy. So
Yeah.
going back to 2008, at the beginning of the global financial crisis, the Federal Reserve balance sheet was about $800 billion. Today, it's $7.5 trillion, meaning in the last 12 years, they've printed almost $7 trillion of new money. Well, where's the inflation? We don't have any inflation in the United States. Now, you do see asset bubbles, but asset bubbles are different. So stock market bubbles and property bubbles, yes. But consumer price inflation, what people pay, clothing's going down, technology's going down, televisions, travel.
Inflation. Yeah.
Yeah, that's deflation. Now,
Yeah.
some things are going up, sure, tuition, but when you look at the whole basket, we have no inflation, about 1.5%. But this isn't 3, 4, 5% inflation. We just don't have it. Why can you print $7 trillion and not get any inflation? Because Milton Friedman and the monetarists and the Austrian school and the neo-Keynesians would all say we have to have inflation, and we don't. The answer is money printing has nothing to do with inflation. Money printing does not cause inflation. It's velocity. It's the turnover of money. So I tell people, if I go out to dinner and I tip the waitress and she takes her tip money and takes a taxi home and the taxi driver puts gas in his car, my money has velocity of 3. My $1 supported $3 of goods and services. That's velocity of 3. But if I stay home and watch television, my money has velocity of 0 because I didn't spend any money. And I tell people $7 trillion times 0 is 0. If you don't have velocity, you don't have an economy.
Yeah.
Velocity is psychological. It's behavioral. How do you feel? How do I feel? Do we want to go out and take our friends to dinner and drinks on us, or do we want to stay home and watch TV? Right now, people are not going out. They're saving. And if you lost your job, you're definitely saving more. But even if you didn't lose your job, there's something called precautionary savings, where it's like, well, I've still got my job, but maybe I'll get fired next week. Maybe my company will fail next month. My spouse is unemployed, et cetera. So savings rates in the United States look like China. I mean, they've gone from 6% to 20%. In last April, it was 33%. So the problem is not money printing. And another way to understand it is, think of money printing as piling up wood. You pile wood, the pile gets higher and higher and higher. But it doesn't start a fire. You need a match, a lightning bolt. You need some catalyst for that. Well, then you have to say, what's the catalyst? Well, the answer
is the trigger, yeah.
Well, it's psychological. But I do explain it in the conclusion of my book. So you're exactly right, Mark. The central banks are stuck. There's no way out. Money printing doesn't work. It only makes things worse in some ways. So the question is, how can they change behavior? How can central banks change inflationary expectations? How can they get you and I and our audience, your audience, to say, oh, gee, the inflation's got better buy a car, buy a house, go shop, get out of the dollar, get out of the euro, as the case may be. There's only one way to do it. You have to raise the dollar price of gold. And 2 presidents in the United States did this. Franklin Delano Roosevelt in 1933 and Richard Nixon in 1971. Now, Roosevelt did it on purpose. He knew what he was doing, and he was trying to get inflation because the problem was deflation.
Yeah.
And the idea of raising the price of gold, it's not to reward gold holders. It does. I mean, if you have gold, the price will go up. I expect gold to go, to $10,000 to $15,000 an ounce in the coming years. But you have to do that. But the reason is not to reward gold investors. It's to get the price of everything else to go up, because the world of, I'll just say $5,000 to have a more, near-term expectation. The world of $5,000 gold is also the world of $400 oil, $100 silver, $20 wheat. In other words, it gets everything else to go up, and that's why they do it. Now, central banks don't understand what we just talked about. They don't understand what I just said. They're supposed to, but they don't know what they're doing. So what I say in the end is, I said, look, if you're a central banker and you happen to be reading my book, here's how you can solve the problem. But if you're not, if the central bankers don't read it, and every day people read it, you can do it yourself. You don't have to wait for the central banks. You can invest in some gold today, and you'll be ready for what's coming.
Mm-hmm. Okay. So you actually you worked with the Federal Reserve Bank together already, because in 1998 you helped to successfully negotiate a rescue package for the long-term capital management fund, a hedge fund which nearly collapsed. So do you still have strings to the Federal Reserve? Can you talk them into some good direction, help them, show them the way, or what's the deal?
No, it's a great question. I still have a lot of ties to Washington.
Yeah.
Some of the 1990s and early 2000s, I was general counsel to a major bank holding company, and I talked to the Federal Reserve all the time.
Yeah.
Regulated by the Federal Reserve Bank of New York. I was also down at the Board of Governors in Washington. And you're right, in 1998, when we bailed out long-term capital management, I negotiated that bailout. It's a very hectic 5 days, on the phones with the
I believe you.
CEOs at the time, Dan Tully at Merrill Lynch and David Kamansky and John Corzine. They're all kind of, this is 22 years ago, but yeah, we had a front row seat. But after that, I worked for the CIA for about 10 years, and I spent a lot of time in Washington doing financial counterterrorism, financial warfare.
Exactly. Yeah. Interesting. Can you tell us something about that as well, or is it secret?
Well, some is. There's some things I can talk about, some not. But I once met with something called the Office of Net Assessment, ONA. Office sounds like a very geeky name, but they are the top think tank inside the Pentagon. They are the futurists of the Pentagon, and they report directly to the Secretary of Defense. And I sat with the head guy, a guy named Andy Marshall, who served 8 presidents. He had been there from Richard Nixon through Donald Trump. And, so you're in a kind of secret environment. And I said, Mr. Marshall, I said, the day will come when you'll have a destroyer or naval vessel in Singapore, and you'll pull up to a fuel dock and you'll say, please refuel my vessel. And the operator will say, fine, pay me in SDRs, special drawing rights, which is the IMF world money. And I said, for the first time, you'll have a forward deployed military that you have to pay for in a currency that you don't print. Mm. And that resonated with him. He said, oh, gee, what happens if the dollar is not, automatically accepted all over the world? But his job is to think 5 or 10 years ahead. Yeah. So I've met with the Treasury. I've met with Tim Geithner. I've met with Ben Bernanke. I've met with the Pentagon. I always get the meetings. That people are very, they'll say, sure, come on and talk, and you're an expert and all that. You always get the meetings. I give them the same advice I'm giving to your audience. It's not like I tell them one thing and tell. Yeah, I know. This is what I tell them. Yeah. But the question is, does anybody listen? No. Or can they do right? Or can they do anything? Because what the Pentagon said is, like, okay, we hear you, but the Treasury really doesn't like it when we talk about the dollar. Yeah. So in effect, they were saying, we understand there may be a strategic threat, but that's the Treasury's job, not our job. But then when you go over to the Treasury, I've had guys pound the table, say, the dollar is the global reserve currency. It is today, and it always will be. And I say, you sound like John Bull in Whitehall in 1913 talking about pound sterling. They could have said the same thing about the English pound in 1913, and yet just a few years later, it was almost worthless. So, so I don't know. I use complexity theory. I use mathematical equations. I use behavioral psychology. But one of my inputs is history. And again, economists don't like history because you can't quantify it. But I say, who cares? First of all, you can't quantify it if you try. But it's so full of lessons, and that's really one of the things people say they like about my books. Like, well, I like your book, thank you. You've explained a lot of things. You've got some very good recommendations, but I really like the history part. And I've had younger readers say, gee, we never knew the U.S. was on a gold standard. And I said, well, it wasn't that long ago. But so I feel that's rewarding when you feel that you can explain things or shine a light on things that people don't understand. And even if you don't have all the answers, at least people feel better if they understand the problem.
Mm-hmm. So what's your thought on the US dollar? We saw last year it was really, really weak. So you think the dollar will be gone one day? Will it be, I don't know, perhaps will we see a new reserve currency from China, or perhaps a digital currency from another central bank, or Bitcoin? What's your take on that?
Yeah, look, central banks are moving to digital currencies, but that doesn't mean anything. It's still the euro or the dollar. In fact, I always say the greatest cryptocurrency in the world is the U.S. dollar because, first of all, I may have a couple in my pocket for lunch or something. In Philadelphia, we call it walking around money. But look, the overwhelming majority of all dollar transactions are digitized today, and all the message traffic is encrypted. So what's the difference? I mean, that's might as well be a cryptocurrency today. So when you see the People's Bank of China doing a pilot program in a digital yuan, yeah, okay, but it's still the yuan. It's not, it's not Bitcoin or Ripple or something else. So the currency, the fact that they're digitizing, however, has a different message, which is they're trying to eliminate cash. It's not that they're getting out of the euro or the yuan or the dollar. It's that they want all the message traffic and holding and investment to be digitized so that they can seize it, impose negative interest rates, trace your whereabouts. It has more to do with surveillance and confiscation than it does with cryptocurrencies. But what they really want to do is get rid of cash. That's another reason to have physical bullion. There was some the Hezbollah message traffic was recently hacked. And it was revealed, and I knew they had $1 billion. Most analysts estimated that they had $1 billion. But it turns out that $500 million of Hezbollah's $1 billion is in gold, physical gold bullion. Now, they're the bad guys as far as we're concerned. But my point is, that makes sense. I would have estimated that without it knowing, because it's not digital. You can't hack it. You can't trace it. You can't seize it. You can't freeze it. It's physical gold. It's heavy. It's kind of hard to move around. But when you're in the digital payment system, I don't care what currency you use, you're very vulnerable, not just to hackers, but to government confiscation. So physical bullion is one way to deal with that. But so yeah, the central banks will move to digitization, but that's not the same as a cryptocurrency. Now, as far as the yuan, my wife hates for me to admit this, but I used to be a registered lobbyist in Washington. I ran an office down there, and I spent a lot of time on Capitol Hill. And the first thing I learned in Washington is you can't beat something with nothing. Yeah. In other words, if there's a policy or program, you don't like it, I hate this program, and you're yelling and screaming. Nobody cares unless you have an alternative. You have to offer something else before you're going to make any progress. You can write op-eds and yell on TV, but it doesn't do you any good. So now apply that to global reserve currencies. The dollar is the leading global reserve currency, and the euro is second. The US dollar and the euro together are almost 90% of global reserves. Not quite, but they're almost 90%. So they're really the only two currencies that matter. Well, if you don't like it, or you don't like the dollar, where's your replacement? Well, let's look at the Chinese yuan. This is something, Mark, that people don't understand about reserve currencies. They say, well, I just said, 60% dollars and 25% euros and et cetera. But it's not like the People's Bank of China has pallets of printed dollars in the basement of their building. They don't have the currency. They have securities denominated in the currency. So China has $1.4 trillion in its reserve positions, but it's held in the form of government securities, treasury notes, treasury bills, et cetera. So the reserve currency isn't really the currency, it's the security denominated in the currency. So if you want the yuan to be the global reserve currency, where's the bond market? There's no yuan bond market. This is a very small one. China, so ask yourself, do they have a sophisticated bond market? No. Do they have primary dealers? Do they have a payment system? Do they have repos, futures, options, when issued trading, auctions, et cetera? No, they don't have any of that. And even if they did, which would take a minimum of 10 years, probably longer to build, they don't have any rule of law. Does anybody trust the Chinese? I certainly don't. So my point is, Europe does, Germany does, the United States does, Great Britain, they have a good rule of law. So they have these things, but China does not, Russia does not. So the idea that the ruble or the yuan are going to replace the dollar is nonsense, because they have a currency. Maybe it'll get used a little bit more in trade, but they don't have the bond market, the infrastructure, the payments, and the law to sustain a reserve currency. So if you don't like the dollar, fine. Show me your alternative. And the same thing with Bitcoin. There's no Bitcoin bond market. I can go out and buy some Bitcoin if I want to. I'm not going to, but you could, and it goes up. But so does you can trade baseball cards or soccer player cards for that matter, bottle caps. But the point is, where's the bond market? And try spending it. The Bitcoin people always put, there's a coffee shop in Brooklyn, by the way, that takes Bitcoin for a cup of coffee. I have a cup of coffee right here. But the point is, although it's probably boarded up today because of all the riots. So yeah, for novelty, a couple of coffee shops take Bitcoin, but you can't spend it. All you can do is trade it with other Bitcoin people. So, if you want to do it, that's fine. I'm not banging the table saying don't buy Bitcoin. I don't own any. I'm not going to. But if people enjoy holding it, that's fine. But it's not a reserve currency. You can't buy anything with it. There's no bond market, and you're just going to trade it back and forth like baseball cards.
Right now, I think the common sense is that Bitcoin is more a store of value, actually, against the inflationary monetary system we have. Because you see, the influence of the US dollar is getting less and less. I think it's 61% of the world is now using the USD. It's getting less and less in the last couple of years. And I guess I think China or Russia, they will look for an alternative. There were some rumors a couple of years ago, because China bought a lot of gold, that there will be a gold-backed monetary system in the future from Asia, from China, from Russia, and so on. So what's your take on this? You think the next monetary system will be backed again with perhaps precious metals or gold?
Well, it could be. I'm not saying it will be, but it could be. But people say things like that, and I say, well, have you done the math? Because seriously, because the objection to a gold standard, I hear it all the time, because I do talk and write about gold, is people say, well, maybe, but there's not enough gold in the world to support trade and commerce. Maybe once upon a time there was, but when you look at all the leverage and bonds and payments and bankers' acceptances and all the world of commerce, there's not enough gold to support that. And I say that's nonsense. There's always enough gold. It's just a question of price.
Exactly.
So at $1,900, which is about today's price, or even say $2,000 an ounce, no. But at $15,000 an ounce, there is. That's how I get to $15,000, by the way. I don't predict a gold standard, but I say, well, okay, let's assume, and I talked to Paul Volcker about this before he died, let's assume you want a gold standard. You have to ask yourself, what does the price of gold have to be in order to support the trade and commerce? In other words, what is the implied non-deflationary price of gold? So what I did is I added up, I took M1 as a definition of money supply. You could use other inputs. I took M1 for the US dollar, the euro, European Central Bank, basically, Japan, England, China, and a couple other countries. But that's almost all the currencies in the world. The Australian dollars, it's sound, but it's not a big market. And that number is around $30 trillion. And then I took, I said, how much gold backing do you need? Well, the Austrians will bang the table. It has to be 100%. Or no, 40% is enough. Historically, 20% gold was enough to support a currency. So let's be conservative and say 40%. Well, 40% of 30 trillion is 12 trillion. How much gold is there? About 33,000 tons. Official gold, not private gold. 33,000 tons. So just, we don't need calculus. You use fifth grade math. If you divide $12 trillion by 33,000 metric tons, it comes out around $15,000 an ounce. So my answer, I'm not predicting a gold standard, but I'm saying if you have a gold standard, the gold has to be about $15,000 an ounce in order to support trade and commerce, given the amount of official gold in the world. Well, that's a good reason to buy gold today. Whether there's a gold standard or not, gold is going to move in that direction, either because there is a gold standard, somebody says, let's do that, or there isn't, and then eventually inflation gets out of control and people run to gold because they've lost confidence in the dollar. So one is sort of ordered and one's messy, but either way, that's where the price of gold has to go. If it doesn't, you'll have the worst depression in history, because you'll have to cut the money supply, but they're obviously not going to do that. And this happened in 1925, after World War I, when France and UK and Italy and others were thinking about going back to the gold standard. Winston Churchill was actually Chancellor of the Exchequer, and he felt honor bound or duty bound to go back to the pre-war parity. The problem is they had doubled the money supply to fight World War I. So in that situation, you have two choices. You can either raise the price of gold to have a new parity, or cut the money supply in half and have the old parity. Churchill chose to cut the money supply in half. He later admitted that was the worst mistake of his life. And it put the UK in depression several years before the rest of the world. So if you want to do it, that's a policy choice, but you got to get the price right. And the math is easy. And the answer is $15,000 an ounce. If that's true, which it is. why not buy the gold today? Because at $1,900 an ounce, because that's where it's going.
Yeah. Yeah, but we see in the last couple of years that the trust into our monetary system is getting more and more damaged through the policy of the central banks. And the question is, if the trust completely dissolves, will people ever trust a fiat currency again? Or exactly, so we need something backed. And if there will be a gold standard or a backed currency, will countries again start confiscating gold like in the 30s in the US? Is this a danger?
Good luck. The answer is they might, but I don't see that. In 1933, President Roosevelt confiscated all the gold before he raised the price. So it was $20.67 an ounce. Roosevelt raised it to $35, but he confiscated all the gold first. So the government took the profits. It was the ultimate insider trade, if you want to think of it that way. If they tried to do that again, I have a feeling that compliance would be very low. I don't advocate, violating any laws, but just as an analyst, as a practical matter, I'm not sure people would be lining up to hand in the gold. But more to the point, if that were going to happen, you would see it coming. In other words, this is why I say people have to be nimble. This is what I do in my book. I tell you what's coming. So you would see it coming. You would see inflation take off. You would see lost confidence. You would see people buying again. So there would be ample time. So the price of gold would be going up on its own. You wouldn't need a central bank to tell you what the price of gold is. It would be soaring on its own. So there'll be ample time if you wanted to sell the gold and take your profits before the government tried to confiscate it. I don't think they will confiscate it, but it's a risk. I would absolutely agree it's a risk. But your answer to the risk is, okay, enjoy the ride and sell it before that time comes. But in other words, unlike 1933, the markets will see it coming and run ahead of the government dictates. And as an investor, you'll have ample opportunity to sell your gold if you want to, or just hold on to it, because I don't think the government can or will confiscate it. They might try, but I don't think it will work.
Okay, what's your take on silver?
Silver is along for the ride. Silver is more difficult to analyze because it is a precious metal, but it's also an industrial input. And so gold is actually not good for anything. It's the best form of money. My view, gold is the best form of money, but it's not good for anything else. People say, what about jewelry? It's just wearable wealth. If you have necklaces and bracelets and all kinds of gold jewelry, it's just gold bullion that you can wear. I don't really think of it differently than a bar of gold or a gold coin. So other than like coating a space helmet or a couple, 5 nines, 99.999% gold, which they use for wire in some applications, which is very, very expensive. Gold's not used for much. Silver is different. Silver is an industrial input. It's used in auto manufacturing and a number of other applications. So you can say, well, silver will go up for all the reasons we just discussed because it'll go along with gold. But then in a depression, it might go down because the industrial demand is lower. So it's a little more complicated. But having said that, there's no way that gold's going to $5,000 an ounce or higher, which it will, and silver is not going to $100 an ounce. So it's a little more complicated, but silver, if gold goes up a lot, silver is going up a lot. It's as simple as that.
Yeah. So Jim, I'm a gold bug as well as you are, and I expect higher prices as well. But we see all the time, the last couple of years, actually in this surrounding at this time right now, gold should be at $3,000 or $4,000. But we see the big players, we see JP Morgan, they also paid a fine, I think $1 billion for manipulating the gold price, the silver price. They manipulate everything actually, and they always go along with it, and they always just pay their fine with the money they made profits on the trading side. So sure. Do you think they will still in the future manipulate the gold price? We will always stay below $2,000, because I made prediction of $5,000 to $10,000 in this decade. You said 15,000 till 2025. So what is when JP Morgan and all the big players on Wall Street say, hey, never again, we manipulate the price of gold, of silver, of everything actually. So they can corner the price all the time.
Right. Well, the answer is there is manipulation, and it's not hard to ascertain, but the manipulation always exists and it always fails. So seriously, go back to the 1960s. the London gold pool. This
Yeah.
was the United States and UK and Germany, a few other countries agreeing that they would dump their official gold to keep the price low. Well, they started running out of gold, so they got rid of that. Then in the late 1970s, the United States, this was after Nixon suspended redemptions, after the price of gold had broken away from $35 an ounce and was going up. The United States sold 1,000 tons of gold between 1971 and 1980 and got the IMF to also sell almost 1,000 tons of gold to suppress the price. It failed. By January 1980, the price of gold was $800 an ounce. So then the United States stopped selling gold. The United States has not sold any official gold since 1980. We've stuck at around 8,000 tons. But we got everyone else to do our dirty work. So in the late 1990s, they got the Bank of England to sell about half of the UK's gold reserves. In the early 2000s, they got the Swiss to sell 1,000 tons. This caused a popular uproar in Switzerland. And then the last effort was in 2010, the IMF sold 400 tons. But it's over. I mean, they've done every one of those manipulations ultimately failed. So they were tried, they were done, they did suppress the price, but they didn't last. And since 2010, that was the last time there were net sales by official institutions. That was the last time. Since then, they've been net purchases. Some individual banks, and Canada sold the last of their gold reserves. I think I have more gold than Canada did at the time. It wasn't that much, to be honest. Sure. But and they have gold in the ground. I understand they have mines. But the point being, all this manipulations fail. So I say, hey, if you want to suppress the price, thank you. I'll just buy more cheaply. And then, when you fail, I'll make money.
Okay. And let's get back to your very excellent book. And I recommend to every viewer, you should read it. It's definitely worth reading it. And there's so many insights and so many recommendations. And yeah, please read it, guys. I will put a link in the show notes. So you expect actually, yeah.
The New Great Depression. Thank you very much.
Yeah, I know. No, it was really great reading it. I have no hard copy. I only have a PDF, but it's very good. And it's published in German as well since yesterday. Yes. And but anyhow, if this scenario from your book rolls out and we see a depression, it's really like a dark winter, like winter is coming in Game of Thrones. So
right.
What do you expect for all of us, for society, and how do you prepare for this scenario? How do you prepare for the depression? Because the one thing is the monetary thing, but what else do you have to do to survive this area, this era?
Well, yeah, right. I have a whole chapter on this in my book, chapter 5, where I talk about the mental health consequences of the pandemic and behavioral changes. So yeah, it's mostly about, it starts out on the virus, and then the lockdown. We talk about the economics, modern monetary theory, monetary policy, fiscal policy, all the things we've discussed. But chapter 5 talks about the mental health aspects, which have been greatly underestimated. First of all, the virus actually penetrates the brain. It penetrates the membrane around the brain. So there have been cases of psychotic reactions and paranoia and people with getting disabilities, et cetera, which is very serious and not much talked about. But beyond that, even if you don't get COVID, even if you're not infected or you've recovered, there are very long-term deleterious mental health aspects of the lockdown. Because we're social people. We like going out, going to dinner, having drinks, going to a sports event, just walking around a park. If you can't do any of that, your apartment or your house becomes like a jail cell. It's like you're in prison. But what are the behavioral aspects of that? Depression, anxiety, anger, and it plays out in the form of violence in the streets. And so I talk about this. And by the way, in the United States, but I think this is true around the world, the suicide rate has tripled. The murder rate has doubled. Alcohol abuse is up, drug abuse is up, domestic abuse is up. The lockdown has cost more lives than it saved. In other words, it might have saved some lives, but more people have died because of the lockdowns than have been saved. And so when you look at the riots we had in the United States last summer, and the riots just a couple of days ago on Capitol Hill, maybe there were different, I condemn all the violence, so I don't pick sides. I would say that they should all be arrested and all be prosecuted. So I'm not condoning any of the violence, but just as an analyst trying to understand it, I say, well, you're burning down cities, now you're attacking the Capitol. You may have a political cause, but where's all this anger and violence coming from? And I attribute some of it, maybe a lot of it, to the impact of the pandemic and the lockdowns.
Yeah, it's horrible. It's horrible.
Yeah.
Yeah. I asked on Twitter the people what they would like to ask you, and there was some very interesting questions. And the one was, Diggy asks, do you expect a military conflict in 2021 which involves the US?
Yeah, it's possible. I don't want to say it will definitely happen, but yeah, the possibility is higher. And obviously there are between India and China and the Himalayas, and China and Taiwan and the South China Sea, and
Okay.
some other hotspots. Probably yes.
Okay. Okay. And Martin Pichler asked, what do you expect first, deflation or inflation?
Deflation first and then inflation. But you can't bet on inflation right now, because you're going to have to live through deflation first. So what I tell investors is be nimble, be ready for both, but they'll come sequentially.
Okay. And what about hyperinflation?
Cannot be ruled out. That's a psychological phenomena. If the central banks get a wake-up call from the deflation and try to manage the inflation, it might be okay. But if they don't, and it gets out of control, as it did in the 1970s, people forget, in 1977, the United States issued treasury bonds denominated in Swiss francs, because nobody wanted the dollar. So that danger is there.
Okay. And last question from one viewer is from Rüdiger. He asks, you said the ECB will go down. What will be the trigger?
I'm not sure ECB will. I mean, interest rates go. I
think that the ECB will close, or the euro will just explode.
Oh no, I don't believe that. I've never said that. In fact, I've said the opposite all along. Go back to 2010, 2011, the euro sovereign debt crisis. Paul Krugman, Joe Stiglitz, where their hair was on fire. It's the end of the euro. Greece is getting kicked out. Spain's going to quit. I said no. I said nobody's getting kicked out. Nobody's leaving. They'll add members, which they have. They've gone from 16 to 19 members in the last 10 years, and the euro will remain. So now the value against the dollar will fluctuate, of course, but no, this is the way to understand the euro. It's not an economic project; it's a political project.
Okay, you think the euro will be in
correct?
Okay, good. This is interesting. We have to make this another one interview, because I see it differently. But this is the last question I have for you. Okay. Something totally different. Nothing about money, depression, or something more deep. What is for you the sense of life?
It's really important to get your priorities straight. So I would say, my family, my religion, my country. Those are the things that really matter. Try not to get too caught up in the politics. Politicians come and go, but the other things are more lasting.
Perfect. Jim, I thank you very much. It was a very exciting interview, and I hope to talk to you soon again.
Thank you very much, Mark.